Landlords and developers are muscling in on the co-working space sector in Singapore. According to property consultancy CBRE, this cash-rich segment of operators has captured a fifth of market share. CBRE expects this to grow, and not even the highly publicized woes of co-working space giant WeWork can stop it.
What seemed to be a bed of roses for the co-working industry across the board last year has now grown thorny for smaller operators. A report by property consultancy Colliers shows that they're either getting bought over or squeezed out because they don't have economies of scale. In contrast, the three biggest players, WeWork, IWG and JustCo, own more than half of the market share. Enter landlords and developers. CBRE puts their share of the market at 20% and expects this to grow thanks to their financial clout and extensive portfolios. Helping them is Singapore's position as an emerging startup hub.
There's a lot of legal support and structure for PropTech, FinTech, tech-driven startups. So that has formed that little foundation of fabric where the sustainability of a co-working business in Singapore is actually quite firm and stable. We have already seen most of the co-working operators enjoy pretty high commitment levels, up to 80 to 90%.
We are a tech ecosystem platform, so being close to community of tech companies, tech corporates is very important for us. So we don't just get to interact with them on a day-to-day basis because all of us share this one space, but all of our clients are also within like a 1 to 2 kilometer radius, so all the offices are around. So it makes interacting with our core community and core ecosystem like very simple.
But risks remain in the sector, as shown by embattled co-working firm WeWork. The US-based giant said last month it would let go of 2,400 employees worldwide, although it's unclear if Singapore would be affected. It's been struggling to reorganize its business amid mounting losses and very high overhead costs. In the 2 years WeWork's been in Singapore, it has added offices at a rate of 1 new location every 2 months. Last year alone, the firm added 6 new offices. WeWork now has the largest share of the market in the country at 22%. Experts say WeWork's business model isn't sustainable in the long run.
The way I believe WeWorks has been running it, which is rapid-fire expansion, very high overhead costs, and also issues with their governance model. In the long term and in the medium term as well, the market share of WeWorks will fall, not just because other players are expanding aggressively, but also because of the restraint it has on itself.
Sharks are already circling, responding to whether it'll be eyeing spaces vacated by WeWork if the American firm exits. JustCo CEO, who runs the third largest co-working operator in Singapore, says,
the answer is yes, but we are not very targeting on any company as long as there's a value proposition. Scaling up the business, we always try to do it organically, or if there is any opportunity for M&A, we look at both, as long as the number makes sense and there's a value.
The heat is on in the co-working space sector, according to experts, who say the battle will be won by operators who can expand market share in the most sustainable manner.